All right, welcome back to the deep dive.
Good to be here.
Today, we've got quite a bit of material in front of us, specifically this really in-depth report making what they call a bull case for Ethereum's asset, ETH.
That's right. And yeah, it's definitely not light reading. It's a pretty detailed analysis, lays out a strong argument for why the authors think ETH isn't just, undervalued now, but maybe significantly undervalued, poised for some major growth potentially.
Okay, so our mission for this deep dive is basically to unpack that, get to the core arguments, understand this vision they're painting for ETH, why they see it as so important, but maybe widely misunderstood.
Exactly. And they use some interesting analogies, make some forecasts that might make you raise your eyebrows a bit. We'll get into those.
Sounds good. Let's dive in then. The report kicks off with this central idea. ETH is way more than just another crypto token.
Yeah, that's the starting point.
Yeah.
And they introduce this really powerful analogy right away. They call ETH digital oil.
Digital oil. Yeah. Okay, so contrasting that with Bitcoin as digital gold. Gold is mostly about storing value.
Precisely. That narrative is pretty established for Bitcoin.
Yeah.
But they're saying ETH is complementary because it actually does something. It fuels activity.
What's the fuel? Like actual oil powers the industrial economy.
That's the comparison they draw. ETH, in their view, is what powers this new digital economy being built on Ethereum. It gets used up. It's necessary for the whole system to function.
Used up, like consumed, burned for operations.
Yes, exactly. Every single thing you do on the network, moving stablecoins, creating a new tokenized asset, using a DeFi app, playing a game, maybe even future AI stuff happening on chain.
Right.
All of that needs ETH to pay for the computation behind it. It's the required input.
That feels like a really key distinction. It's not passive, it's actively used. But the report also calls it a store of value asset with yield. That seems quite different from gold or even Bitcoin.
Yeah, and this is where the idea of a productive asset comes into play. You can just hold ETH like gold.
Sure.
But you can also put it to work securing the network by staking it.
Staking. That's where you lock up your ETH, become a validator, help run the show.
Correct. You validate transactions, keep the network secure, and for doing that, you earn rewards, paid in more ETH.
Ah, okay.
And the report really highlights this yield. It's a big differentiator. You're not just storing value, you're actively participating and accumulating more.
So it's active, not passive. Got it. Third point they make. Pristine settlement collateral. That sounds serious. What do they mean by that?
Well, they argue that within this whole Ethereum ecosystem, ETH is like the ultimate foundation of trust. It's what secures billions of dollars worth of other assets, stablecoins, tokenized real-world things, financial apps.
Because it can't be easily censored or controlled by one group.
Exactly. It's censorship resistant, it's neutral, and crucially, it's immune to like inflationary debasement from a central bank or something.
And they have numbers on this, how much ETH is used this way.
Yeah, they do. The report mentions about 32.6% of all ETH is currently locked up in these kinds of collateral or securing roles. Another 3.5% is used on other chains. And they really stress that as more assets from the outside world, think stablecoins or tokenized bonds from big institutions, come onto Ethereum.
They need something reliable to back them.
Precisely. They need neutral, trustworthy collateral. And ETH provides that. They go pretty far, actually calling ETH the highest grade trust on the planet within this digital context because there's no counterparty risk tied to it.
Highest grade trust on the planet. Okay, that's a bold claim. And it links to its monetary side too, right? The idea that it can be a deflationary asset.
Right. This loops back to the digital oil idea and that burning mechanism we mentioned.
We're using it destroys it.
Yeah. A big chunk of the transaction fees paid in ETH, currently around 80.4%, just gets permanently removed from the supply. Burned. Gone.
So wait. The more people use the network, the more ETH gets destroyed.
That's the dynamic. Unlike, say, oil, where more demand might eventually lead to more drilling, here, more demand, more usage can actually shrink the total ETH supply over time. Creates this really powerful deflationary pressure.
That's fascinating. Okay. It's also described as a reflection of tokenized economy growth.
Yeah, another parallel. Just like you might look at oil demand to gauge global economic health. They argue ETH's value and the demand for it directly reflect how much the on-chain economy built on Ethereum is growing.
And that economy is already pretty substantial.
Oh yeah. The report pegs the total value secured TVS across the Ethereum ecosystem at over $767 billion.
Wow.
And the thinking is, as more finance, more assets, more stuff moves on-chain, ETH is right there positioned to capture that value.
Okay, point 6. It acts as a reserve trading pair,
Think of it like the US dollar in the traditional Forex world.
the main currency everyone trades against.
Exactly. On decentralized exchanges within the Ethereum ecosystem, ETH is the main base currency. The report says 70.6% of trading pairs are ETH against something else, or an ETH derivative against something else.
So if you want to swap between two obscure tokens, you probably go token A to ETH, then ETH to token B.
Very often, yes. It's the main intermediary, the default digital cash within that system.
Makes sense. And the last characteristic they highlight, it's becoming a strategically stockpiled asset.
This is a trend they see really picking up steam. It's not just individuals holding ETH anymore.
Who else?
Applications, protocols built on Ethereum, and increasingly, institutions are actively buying and holding ETH. They talk about a sort of race to stockpile ETH.
Why? As a reserve.
Yeah, as a strategic reserve for their operations, for their treasuries. The report mentions nearly $2 billion in holdings that institutions have publicly signaled.
And unlike just holding cash in a treasury, this stockpiled ETH isn't just sitting there, right?
That's a key point they make. It can be put to work, staged for yield, used as collateral in DeFi, put into liquidity pools.
So it's a productive reserve asset.
Exactly. Yield-bearing, useful. Much more dynamic than, say, holding gold bars in a vault.
Okay, so pulling all that together. Fuel, yield-bearing store of value, top-tier collateral, potentially deflationary, captures ecosystem growth, main trading pair, strategic reserve. Yeah, I can see why the report argues you can't just slap a normal stock valuation model, like DCF, onto ETH.
Right. They say it's a totally new kind of asset class. It doesn't fit neatly into old boxes.
Which leads us nicely into, well, how do they think about its monetary design and potential value? They describe the design as simple, transparent, and sustainable.
Yeah. Let's get into the mechanics. First, how new ETH is created the issuance.
How does that work? Is it mined like Bitcoin used to be?
Not anymore. Since the merge, it's tied to staking. The amount of new ETH issued is programmatic, based on how much ETH is currently being staked to secure the network. There's a public formula for it.
VAX annual ETH issuance equals 166.3 times the square root of staked ETH. Okay, so the more ETH is staked, the more is issued, but the rate of increase slows down.
Exactly. It encourages staking for security, but prevents runaway inflation. The report notes there's a theoretical maximum annual issuance, like an absolute cap of 1.51% of the total supply.
But that's only if everyone staked their ETH and nothing got burned.
Right, which is basically impossible.
Yeah.
So what are the numbers in the real world?
Yeah, what's it actually doing?
Well, right now, only about 28% of all ETH is staked. So the actual issuance rate before any burning is only around 0.8% per year.
Okay, 0.8%. Still low.
But here's the kicker. Remember the burn mechanism.
Taking fees out of circulation.
Yeah. When you factor that in, the average net change in supply issuance minus burn since the switch to proof of stake back in September 2022, it's been incredibly low, just 0.09% per year on average.
Wait, 0.09%? Less than 1/10% net inflation annually.
Yeah.
That's tiny. Compared to like the 2% target for regular currencies or even Bitcoin's current rate around 0.85%, 0.09% is practically flat, sometimes even deflationary if burn is high.
It's a profound difference. The report really hammers this point. This balance between issuance for security and burn from usage creates this unique dynamic where ETH's supply is incredibly stable, far more so than traditional money or even Bitcoin, and it naturally tightens as the network gets used more.
That's a powerful monetary property, which leads into their direct comparison. ETH as digital oil versus BTC as digital gold. Let's maybe tick through the main points from their comparison chart.
Sure. So issuance inflation, we just covered ETH currently around 0.68% pre-burn. That tiny 0.09% average net can go negative, max 1.51%. Bitcoin, currently around 0.85%, cuts in half roughly every 4 years the halving.
Supply cap. ETH doesn't have a hard cap like Bitcoin's 21 million. It uses predictable issuance instead, aiming for long-term security. Bitcoin has the cap, but the report does raise a question mark about what incentivizes miners long-term once the block rewards get really small. Will fees alone be enough?
It's a valid question. Then the burn mechanism, big difference. ETH has it that 80.4% of fees burned. Bitcoin doesn't.
Yield. ETH offers that native yield from staking, plus a share of transaction fees for validators. Around 3% currently, give or take. Bitcoin, natively, none. You can lend it out, but the protocol itself doesn't generate yield.
Right. Economic activity. For ETH, more activity means more burn, potentially less supply, and higher yields for stakers. It's directly linked. For Bitcoin, activity levels don't change its fixed issuance schedule.
Utility. ETH positioned as store of value, plus that broad utility, the fuel. Bitcoin primarily seen as store of value.
Energy use. Massive difference here. ETH post-merge is tiny, like zero point zero 0.01 terawatt hours per year. Bitcoin's proof of work is energy intensive, 175, nearly 176 2Y-year, according to the report's figures. Huge gap.
Yeah, that's stark. And security model. ETH relies on those distributed validators staking economic value their ETH. The report argues this is robust, decentralized, low overhead. Bitcoin uses specialized mining hardware, high energy cost, which they suggest could lead to more centralization risk over time, plus that long-term incentive issue.
So yeah, putting it all side by side, they paint a picture of ETH having quite a few unique advantages, especially around utility, yield, and its monetary dynamics.
Which naturally leads them to ask the big question. If ETH has all this going for it, why has ETH lagged BTC in price performance, especially recently?
Yeah, the elephant in the room.
And their answer isn't that ETH is flawed, but it's about the story, a narrative disconnect.
That's their core argument. Bitcoin's digital gold narrative is simple, powerful, and it's had, 15 years to sink in with investors, institutions?
Right. Everyone kind of gets it.
Exactly. ETH's story is just richer, more complex. It's programmable money, it's digital oil, it's a settlement layer, it's a yield-bearing asset. It's harder to fit into a quick soundbite.
So the market hasn't fully grasped the whole picture yet.
That's what they believe. This complexity leads to it being potentially misunderstood and therefore mispriced relative to its actual utility and potential.
So when they see ETH trading near its lows relative to Bitcoin, they don't see weakness, they see an opportunity because the market is slow on the uptake.
That's the strong implication, yes.
Yeah.
A temporary mispricing due to this narrative gap.
Okay, what about the critique you sometimes hear about layer twos? You know, the argument that moving activity onto these faster, cheaper layers actually takes value away from ETH because it lowers fees on the main Ethereum chain, the L1.
Ah, yes, the report tackles that head-on. They call that view a fundamental misunderstanding of Ethereum's whole scaling strategy.
How so? Don't lower L1 fees mean less burn, less yield for ETH holders?
In isolation, maybe, but that's missing the bigger picture. They argue that enabling low fees on L1 was a deliberate, necessary step to allow massive scaling through L2s. Think of L2s like building, thousands of new high-speed lanes feeding into a main highway.
Okay.
The toll on any single car using those new lanes might be lower, but those lanes all eventually merge back onto the main highway, the Ethereum L1, to finalize their journeys. L2s bundle up thousands of transactions and pay a single fee to settle that batch on L1.
Ah, so L2s still pay fees to L1.
Yes, and by enabling vastly more total activity across the entire ecosystem activity that just wouldn't have been possible directly on L1 due to cost or speed, L2s actually end up driving more demand for L1 block space in aggregate.
So more total transactions being settled, even if batched, means potentially more total fees burned on L1 and higher overall yield for stakers in the long run.
Exactly. It's about massively expanding Ethereum's total addressable market. So from the report's perspective, the L2 strategy is structurally bullish for ETH long-term, not bearish. It makes Ethereum scalable for potentially billions of users.
Okay, that reframing makes sense. It's about the total pie getting much bigger, not just how the existing slices are divided. And this complexity, this unique nature, means traditional valuation methods just don't cut it.
Precisely. They're very clear. ETH is not a tech stock. You can't just do a discounted cash flow geared on fees.
Because the fees aren't profit, they're an input. The oil being burned.
Right. A DCF misses the commodity aspect, the store value aspect, the yield, the crucial role as collateral. It just doesn't capture the whole picture.
So, if not DCF, how do they suggest thinking about ETH's value?
They turn to comparable-based frameworks, basically looking at ETH as this foundational global reserve asset or commodity for the digital world and comparing it to analogous things in the traditional world.
Okay, what kind of comparisons do they make?
They offer a few interesting ones. First, the oil reserve benchmark.
Back to the digital oil idea.
Yeah. Comparing ETH's role as essential fuel, its scarcity through burning, its strategic importance, comparing that whole picture to the global market for oil reserves, which they value at roughly $85 trillion.
Wow, $85 trillion. Okay, that's a big number to compare to. What's the second benchmark?
The asset tokenization benchmark. This looks at the sheer scale of global wealth estimated around $500 trillion.
All the world's assets, stocks, bonds, real estate.
Pretty much everything. And the report says, look, even if just a conservative 10% of all that eventually gets tokenized and lives on Ethereum.
That would be $50 trillion worth of assets.
Right. $50 trillion secured by Ethereum. And their point is, if Ethereum is securing that much value, does it make sense for ETH itself, the asset doing the securing, to only have a market cap of, say, a few hundred billion? They see a fundamental mismatch there.
Yeah, that gap is huge. What's the third comparison?
Neutral, pristine collateral. Here, the parallel is drawn to things like U.S. Treasury bonds in the traditional system.
The ultimate safe, trusted collateral.
Exactly. But they argue ETH has even more upside potential because it's globally neutral, not tied to any single country, and its value is directly linked to the growth of this whole new digital economy.
And the final one, store of value economics.
This loops back to comparing ETH's properties to gold. Things like its very low or negative net inflation, its use as a reserve asset within its ecosystem, its non-sovereign nature.
Okay, so based on these different comparisons, oil, tokenized wealth, treasuries, gold, the report actually puts forward some potential valuation targets.
They do. They kind of average out these benchmarks and suggest a long-term potential market size or valuation for ETH in the ballpark of $85 trillion.
$85 trillion, same number as the oil reserves comp. What does that translate to on a per ETH basis, roughly?
Based on current supply figures they were using, that implies a price of around $706,000 per ETH.
Okay. $706,000 per ETH. That's definitely a long-term aspirational kind of number. It makes you pause. Do they offer any sort of intermediate steps or targets?
Yes, they do. They suggest a shorter-term target could be around $8,000 per ETH. That would put ETH's total market cap around the $1 trillion mark.
Still a big jump from today, but maybe more conceivable in the nearer term.
And then a medium-term target of $80,000 per ETH, which would correspond to about a $10 trillion market cap.
$1 trillion, $10 trillion, eventually $85 trillion. These are obviously huge potential increases. What do they see as the main drivers, the catalysts that could actually make this kind of repricing happen?
They list 4 main catalysts to watch for. First, just a big surge in demand for all kinds of tokenized assets being built and traded on Ethereum.
More stuff moving on-chain.
Second, accelerating demand for ETH's native yield, that staking reward. They specifically mention the potential impact of things like staked ETH ETFs becoming available to more investors.
Making it easier for traditional finance to get exposure to that yield.
Third, that trend we talked about. More strategic stockpiling of ETH by protocols, applications, and importantly, institutions using it as a reserve asset.
Enforce.
ETH becoming more widely adopted as a treasury asset by companies and institutions beyond just crypto-native ones.
Okay, so that covers the bull case for ETH, the asset itself. But as we said, its value is tied to the network it runs on Ethereum. The report also spends a lot of time arguing why Ethereum is the winning infrastructure.
Absolutely. They argue ETH's value proposition is inseparable from Ethereum's success as the foundational layer for this whole digital economy they envision.
So what makes Ethereum uniquely suited for that role, according to the report?
They list quite a few reasons, really focusing on its track record and core capabilities.
Yep.
First off, its battle-tested uptime and resilience.
Meaning it just works, doesn't go down.
Pretty much. Critically important for anyone building serious financial applications, they note it hasn't gone offline since way back in 2015. Despite countless upgrades and, market volatility, having multiple independent software clients running the network adds a ton of redundancy too.
That reliability is key. Second, it's credibly neutral infrastructure.
This is huge. Its rules are set by open source code, not a single company or government deciding things behind closed doors. That neutrality eliminates a huge layer of counterparty risk you'd have with traditional systems or more centralized blockchains.
Makes sense. Then decentralization at scale.
Thousands of validators spread all over the globe running the network makes it incredibly hard to censor or control.
And, crucially, unmatched market share in key areas.
This is a point they really drive home. Ethereum isn't just a platform, it's the dominant platform for the most valuable stuff right now. It hosts something like 60% of all stablecoins.
Wow.
And an even more dominant 82% of tokenized real-world assets, or RWAs.
So things like tokenized bonds or funds.
Exactly. And they name names BlackRock, JP Morgan, Franklin Templeton. They point to over $10.2 billion in these non-stablecoin tokenized assets from major institutions already running on Ethereum or its associated networks.
Yeah.
This isn't just theory. big finance is actively building here now.
So it's not just about having the most users, it's about having the most valuable activity already happening there.
Precisely, which makes it the high-value settlement layer, securing that $767 billion in total value secured we mentioned earlier.
What else?
Well, they also highlight things like the most secure developer tooling, the Ethereum virtual machine, EVM is battle-tested, widely understood. Transparency is key. Everything is open source, auditable. There's a clear roadmap for scalability using both L1 improvements and the L2 ecosystem.
And they mention specific features attractive to institutions.
Yeah, things like the ability to create custom environments on layer 2s or private chains that still settle to Ethereum, allowing for things like privacy controls or KYC compliance if needed, plus the robust security model of proof of stake with slashing penalties for bad behavior.
So, strong foundations. But the report goes further, arguing Ethereum is entering a kind of renaissance right now. What's driving that?
They see several converging factors. First, they describe a more coordinated, proactive ecosystem.
Meaning, less purely academic, more focused on adoption.
Kind of a shift from just focusing on research and development to actively promoting Ethereum, engaging with policymakers, working with institutions, especially now that there's a bit more regulatory clarity emerging.
Okay, second driver.
Ethereum Layer 1 is scaling without sacrificing decentralization. They point to technical breakthroughs happening, like new virtual machines, ZKVMs, that are making the base layer itself more efficient.
Scaling vertically.
Right, while the L2s provide that horizontal scaling. So it's scaling in multiple ways while trying to maintain its core decentralized nature.
And those L2s are getting better too.
Definitely. Point 3 is Ethereum's L2s are faster, cheaper, and more interconnected. They acknowledge early L2s felt a bit fragmented,
Yeah, like separate islands.
but argue that interoperability standards are developing fast, making it easier to move assets and data between them. And we're seeing huge growth and real institutional adoption on these L2s. I mentioned Deutsche Bank, Sony, UBS, plus platforms like Coinbase's Base, Kraken's Inc., WorldChain, all leveraging Ethereum L1 for their security.
So L2s are maturing quickly. What about actually using this stuff?
That's the fourth point. User experience entering fintech phase. Things like account abstraction, which really started gaining traction around May 2025, according to the report.
Making wallets easier to use.
Yeah, enabling things that feel more like modern web apps, biometric logins instead of complex seed phrases, easier key management, social recovery options if you lose access. It's about removing that friction that's kept mainstream users away.
Making it less scary, basically.
Exactly, which ties into their fifth point. Institutional adoption is no longer hypothetical, it's accelerating.
Bringing together those earlier points about market share and neutrality.
Right. They argue this isn't just a few experiments. It's becoming structural. Ethereum's features just align well with what institutions need for this new era of tokenized assets, neutrality, security, programmability, auditability. They even suggest Ethereum might be approaching a kind of ChatGPT moment,
Meaning?
where suddenly the broader market has this realization, oh, this is the foundational infrastructure everyone's going to build on.
Interesting comparison. Point 6 for the Renaissance.
Regulatory clarity is imminent. They see the repeated confirmations of ETH's commodity status in the U.S., the ETF approvals in 2024, and the general expectation of clearer global frameworks in 2025 as major de-risking events.
And the fact that big banks are actively building suggests they're getting comfortable too.
Exactly. And the final point, pulling it all together. Contrarian capital is circling.
Because of that perceived mispricing.
Yeah. Given Ethereum's dominance, its utility, all these positive trends, the report argues ETH is significantly underowned and undervalued compared to, say, Bitcoin or even traditional tech assets. They frame it as this compelling, mispriced, asymmetric bet.
Like finding AI stocks before the boom, or Bitcoin back in 2020.
That's the kind of parallel they draw, yeah.
Yeah.
An opportunity hiding in plain sight, perhaps.
Okay, so we have this powerful infrastructure, this unique asset undergoing a renaissance. What about the really long view? The report also touches on AI, right? The convergence of AI and digital finance.
It does. This is more speculative, looking further out, but potentially a massive driver. They start by highlighting the sheer amount of money pouring into AI compute right now. NVIDIA's revenues, Meta, Microsoft, Apple spending hundreds of billions collectively just on AI infrastructure.
Building the brains, basically.
Right. And this leads to the idea of autonomous AI agents, software programs that can act independently, make decisions, manage resources.
Little digital employees or actors.
Kind of.
Yeah.
And the key question is, how will these agents interact economically? They'll need things traditional finance can't easily provide,
Like,
like programmable money they can control directly, verifiable digital ownership of assets or data, and the ability to transact instantly, globally, 24/7, without needing a human banker in the middle.
and the argument is Ethereum is built for that.
That's what the report contends. Traditional finance is slow, requires intermediaries, operates during banking hours. Many other blockchains might lack the combination of security, decentralization, programmability, and the established ecosystem Ethereum offers.
What specifically does Ethereum offer these agents?
Things like guaranteed transaction execution, finality, smart contracts for complex agreements, global property rights enforced by code, not courts, direct access to stablecoins, DeFi protocols, data feeds, oracles, identity systems, all built in and permissionless, plus the speed for agents to react and trigger actions instantly.
So it's not just about payments, it's the whole operating environment for a digital agent.
Exactly. The report calls it a tool chain for agent development and collaboration. Things like decentralized ways to manage data, frameworks for tokenizing anything an agent might own or need, even marketplaces for trading AI models or compute resources.
So you could have AI agents discovering each other on Ethereum, collaborating on tasks, and paying each other directly in ETH or stablecoins.
That's the vision. Decentralized networks of agents, maybe tackling complex problems in logistics or finance or science, with ETH acting as the sort of universal medium of exchange and coordination for this emerging machine-to-machine economy.
Wow. Okay, that's definitely looking out towards the horizon. Let's try to wrap this up then. Synthesize the core bull case presented in this report.
Sure. Fundamentally, it positions Ethereum as the likely foundational infrastructure for a future digital tokenized economy.
The base layer.
Right. And ETH, its native asset, isn't just a speculative token. It's this unique digital oil essential fuel, a yield-bearing store of value, pristine collateral with deflationary characteristics.
Which the market, they argue, currently misunderstands and undervalues.
Exactly. It's seen as significantly mispriced, especially considering the tailwinds like institutional adoption getting serious, L2s making it scalable, the user experience improving, and then this longer-term potential with AI.
And the potential scale is just enormous, tens, maybe hundreds of trillions in assets eventually living on this infrastructure.
That's the ultimate vision they lay out based on those valuation comps we discussed.
And for you listening, why this deep dive matters isn't just about whether ETH goes up or down tomorrow. It's about understanding this potential shift, this infrastructure being built that could underpin a lot of future economic activity.
Yeah, it's a really detailed, provocative case for a potential transformation. Whether it plays out exactly like this, who knows? But the arguments are compelling.
And they leave us with that really big, kind of mind-bending final thought to chew on right out of the report's conclusion.
Yeah. If these autonomous AI agents really take off and become a major economic force, what does it actually mean if ETH becomes the native currency, the main reserve asset for this hybrid economy of humans and machines?
What kinds of completely new economic models or possibilities does that future unlock? Things we probably can't even imagine clearly today.
It's definitely a question that stretches the mind,
Gives you something to think about long after this deep dive ends.
for sure.
Okay, well, that brings us to the end of this deep dive, unpacking the arguments from this very comprehensive June 2025 report, making the bull case for ETH. Thanks for joining us.
Yeah, thanks for listening. We definitely encourage you to dig into the ideas further if it sparked your interest.
See you next time.